Hello and welcome to a discussion on cash and how to prepare a bank reconciliation. After viewing this video, you should be able to state the controls the accounting department should put in place to safeguard its cash, describe the differences in activity stated on the bank statement and what was recorded in the cash account, and complete a bank reconciliation. Cash is money or any instrument that banks will accept for deposit in a bank account. Cash includes paper money, coins, checks, money orders, and bank drafts. Cash necessary to pay for goods and services is kept in an operating account at a bank. Companies deposit cash in the operating account and then write checks to make payment to suppliers out of that same operating account. The accounting department is responsible for managing cash. This responsibility includes keeping enough cash on hand to pay liabilities, using the excess cash to maximize interest earned, recording and reporting cash transactions, and preventing theft. Cash is a very liquid asset that is very susceptible to theft. Controls must be put in place for every step of the accounting process to ensure that fraud does not occur and cash is not stolen. Common internal controls that safeguard cash and prevent fraud and theft requires separation of duties. Separation of duties should be done for accounting for receipts and payments, for handling cash and accounting for cash, for authorizing purchases and authorizing payments. Cash and checks should be deposited daily. Pre-numbered checks should be used. The bank reconciliation should be prepared monthly. Require your employees to take vacations, and retain all of the documents associated with the accounting process. Blank checks should be kept in a locked area with limited assets, and only designated personnel should be able to sign checks and handle cash. Collusion occurs when employees work together and cover for each other to commit fraud. Employees should be cross-trained to do different jobs, and duties should be changed periodically. Employees are likely to avoid collusion when they know job duties will be changed without notice. Employees who understand the entire accounting system and procedures will often notice when things just do not seem right. The company receives a monthly bank statement from the bank that documents all the transactions recorded during the month by the bank. This bank statement details items the company recorded and the bank processed. Pre-approved electronic transactions between the company's bank and the company's lenders, suppliers, or customers, which have not yet been recorded by the accounting department, and items the bank processed and no documents were processed or recorded by the accounting department. Companies use the bank statement as the source document to record pre-approved electronic banking transactions. The cash balance on the bank statement will be different than the company's cash account balance at the end of the month. A bank reconciliation should be done by the accountant monthly to reconcile the difference between items the company recorded in the cash account and items the bank processed. Once reconciled, the adjusted cash account and the adjusted bank statement will reflect the same amount of cash. Accountants use a common format to reconcile the cash balance to the bank balance. The bank reconciliation begins with the ending unadjusted cash balance of the company and the ending cash balance on the bank statement. Two columns are used, one for the company cash account and one for the bank statement. The bank reconciliation begins with the ending unadjusted cash balance of the company and the ending cash balance on the bank statement. The two columns are used, and the differences listed to get the same total represent items the company has not yet recorded or items the bank has not processed. There are common differences in what the company has recorded by the end of the month and what the bank has processed and adjusted for at the end of the month. Checks written by the company may be cleared in a different period than a check was written. Cleared by the bank means that the entity the check was written to has cashed the check and has been paid out of the company account. Deposits made by the company may be added to the account by the bank in a different period. Items the bank has not yet processed that the company has recorded are written in the bank statement column. The two most common items are deposits in transit and outstanding checks. Checks written to suppliers may not be taken to the bank by suppliers immediately. Checks that have been written and not yet cashed by the bank are referred to as outstanding checks. The cash account is decreased on the day a check is mailed to the supplier. The bank account decreases when the check is cashed by the supplier and the supplier is paid cash from the company's account. Outstanding checks are checks the company has written and sent to suppliers that have not yet been cleared by the bank. The accountant compares all checks written to all checks cleared or deducted from the account by the bank. Checks not yet cleared by the bank are included as outstanding checks in the bank column on the bank reconciliation. Deposits in transit are deposits made by the company and recorded as an increase in cash, but the bank does not process it until the following business day. The cash account is increased on the day the deposit is taken to the bank. The deposit made by the company is referred to as a deposit in transit until the bank adds the amount of the deposit to the account. The accountant compares all deposits made to all deposits processed by the bank. Deposits taken to the bank that are not reflected on the bank statement are included as deposits in transit in the bank column on the bank reconciliation. Items the company has not yet recorded in the cash account that the bank has processed are written in the cash column. These include electronic payments to suppliers, receipts from customers, and payments related to borrowings. They also include non-sufficient funds checks, which are bounce checks, bank fees, and interest earned. A non-sufficient funds check is a check from a customer who had no funds in their account for the bank to transfer to the company's account. The accountant recorded the receipt of the check as cash received and later discovered the company was not actually paid. This is often referred to as a bounce check. The company recorded an increase to cash and a decrease to accounts receivable when the check was received and deposited, because the company assumed the bank would add cash to their bank account. This did not occur, and the company must reverse the original journal entry with a credit to cash and a debit to accounts receivable. The customer still owes the company. Errors made by the company or the bank are identified when the company reconciles the bank statement to the cash account. The entity that made the error must correct the error, and the amount required to correct the error is written in the column of whoever made the error. Let's look at an example. A check written by the company to a supplier in the amount of $257 is incorrectly cleared by the bank for $275. The bank deducted $18 too much from the company's account. The bank made the error, and the $18 that it will take to correct the bank account is written in the bank column. The bank must add $18 to the account to reflect the correct balance. Once the error is corrected, the cash account and the bank statement will reflect the same amount. Accountants use a common format to prepare a bank reconciliation. The bank column begins with the balance for the bank statement at the end of the period. Deposits that have not yet been processed by the bank are added, and checks that have not yet been processed by the bank are subtracted. The account is also adjusted for any errors that must be corrected by the bank. The adjusted bank balance reflects a balance as if all activity had been recorded by the bank. Another column is used for the cash account. The reconciliation of the cash account begins with the unadjusted balance in the cash T account at the end of the period. Activity that the bank reflected on the bank statement that has not yet been recorded by the accountants is stated on the reconciliation. Common items are electronic deposits and payments, service charges, and interest. The adjusted cash balance will be the balance of cash after recording all transactions that occurred during the month. No journal entry is made for items listed in the bank column. The bank will account for these items when they are processed or their error is corrected. The company has already recorded the receipt and payment of cash and should not record the items again. An entry to the cash account must be made for all items listed in the cash account column. The items are listed because the company has not yet made an entry to the cash account. Positive amounts in the cash account are recorded with a debit to cash and a credit to the account name affected. Negative amounts on the cash column are recorded with a credit to cash and a debit to the account name. The journal entry to adjust the cash account is an adjusting entry at the end of the period. After viewing this video, you should be able to state the controls the accounting department should put in place to safeguard cash, describe the differences in activity that's on the bank statement and was recorded in the cash account, and complete a bank reconciliation. Please go to studymyaccounting.com and work through the practices you learned for examples of how to do the bank reconciliation. Then work the practice test. Please write out your answers and check your understanding to the answers provided. Thank you for being prepared for class. It is very much appreciated.